there are two kinds of economic policies in this country. One is fiscal policy, which is run by the federal government itself out of the Treasury Department. And that is the federal government's budget of spending and taxing. That's fiscal policy. The other policy, which is far more important, is conducted by and is a responsibility of the Federal Reserve System. And of course, if those two policies conflict, we'll have horrible circumstances.
I think it's very revealing that looking at the history of the Federal Reserve since we've had it, that the chairman of the House Banking and Currency Committee, with a couple of exceptions, have been very opposed to the Fed, very critical of it, and would like to see it abolished.
I don't think abolish is the word, Frank. I think brought under political control and brought in as part of the government.
Okay.
The advocacy is for the Federal Reserve to become a branch of the Treasury, and that's where it ought to be, and that's what ought to happen. But it's probably never going to happen because we're already losing. Us citizens have already lost control of the government. Is there any reason to think that we're going to gain control of something like this? It's not going to happen unless we do something else. Point up the temple aspect of this thing, that the Federal Reserve is treated like, even by the press and by the public, as some kind of a magic arrangement and a religious arrangement, and maybe like the Catholic Church. The chairman is the Pope, and the various members of the Open Market Committee are the bishops and the cardinals, and they go around speaking this Latin language and doing these strange things, all of which is supposed to be good for us and preordained, and so we shouldn't question it or pay much attention to it. And that's the way it works. 33% of the people in a recent poll appear to understand that the Federal Reserve is the one that controls the money supply, meaning they're the ones that control the economy. The other 66%, I don't know who they think does it, but they don't know that the Fed does that. And the Fed is in total control of the economy. The government isn't, the President isn't, Congress isn't, the Federal Reserve is. And they do it in a secretive way, in an undemocratic way, in a way that suits their own purpose and their own very narrow clientele, which are the rich people and the bankers and the Wall Street people.
Then what happens to that creditor money? The banks, how do the banks...
The banks then create money through the banking process by making loans.
Because...
But they make bank money, and bank money is deposits. And so they expand their deposits by making these loans. When you make a loan, what you do is tell whoever you make the loan, okay guys, we have just created a credit in your name in our deposit account. So what they do is just open up a new deposit in that bank, which acts like money, and you can check on it.
So they're really creating money.
They're creating money, and that's the magic here. The whole notion of creating money, particularly paper money, has a magical air about it. It's one thing to understand that gold or silver can be money. Once you mine it, it's worth something, it's money. But to create money, paper money, out of thin air and buy things and do things with that is magical. It has a religious connotation. And that's what Grider argues. And that's why it's called the temple, because the institution that creates the money in this magical way has got to have something religious about it. Well, there's more than that, though, of course. It goes on to the fact that if you create too much money, if you spend too much money, it's sinful. You are a sinful person, or you are a sinful country. You have overspent your ability, and you must suffer. The result is that you must pay the price, and the Fed makes you pay the price. And therefore, we've got all these Calvinistic attitudes about money and overspending and underspending, and that's why it's called the temple. And that's why the politicians, I guess, don't want to be responsible for it, and they are not. Only these Fed people are responsible for this, and they are answerable to nobody.
Now, why would they want to increase the money supply?
Well, if the country needs to expand, and to the extent that there's no inflation, then that's always the overriding concern. Is there inflation? Is there danger of inflation? Then, of course, as the country creates wealth through manufacturing and through production, there's got to be an additional amount of money to cover that. Otherwise, there's not enough money to cover the new additional wealth, and you will have depression and deflation, which is what we had all during the last century. We had deflation all during that time because there was no Fed to create money. There was no increase in the gold supply, and that's the way the gold was based in those days, and yet we had this tremendous increase in production. And there was no money to cover the increased production, so there was deflation because there was the product was worth more in monetary terms then.
Isn't that the problem that people have with people saying that we should go back on the gold standard, a strict gold standard, because the gold, the money supply cannot increase when you need it, only if you get more gold or there's more gold mined?
That's true. What you do is mortgage your ability to grow and to expand to the South African gold mines, because that's the only place gold comes from, is the South African gold mines. And if they decide to shut the gold mines down, then you can no longer expand your money supply if you're dependent on gold.
So they have to have a flexible system where they can print more money whenever they need to.
Well, that's right. What we need...
Or provide more credit.
We know how this system works. We shouldn't be dependent on some crazy international commodity, which is gold and silver, to allow us to do what we want to do with our economic system. We can handle that in a different way, and we don't have to depend on miners or opening up new mines or whatever to do that.
Now, if the Fed increases the money supply, that only goes to the banks that are part of the Federal Reserve System.
No, it gets to all of them.
I mean, just through circulation?
Yeah, because let's assume first that only Federal Reserve members buy or get the bank credit, which isn't true. Anybody with bonds can sell those bonds to the Fed and get bank credit.
Treasury bonds, you mean? Treasury bonds,
right. And so if the Fed is in the open market to sell bonds, anybody can do that.
Okay.
And that includes insurance companies, individuals, anybody. But only the commercial banks have the ability to expand the money by making bank money. So that's where the expansion takes place. So any bank that gets bank credit can expand the money supply, whether it's a Fed member or not.
Now, can the Fed help to create prosperity by creating more money, thereby stimulating the economy, or does it only follow when the production goes up, like you say?
Theoretically, the Fed is supposed to follow production and expand the money supply to accommodate it. But it doesn't always do that, and that's been the problem. In fact, it's been just the opposite in cases, and it has been a failure in a lot of cases to do what it should have obviously done, which is accommodate production. It is overly concerned with inflation. It's overly concerned with wages being higher than somebody thinks they ought to be, and so its interest is not to accommodate production, but to cut off wage increases and to increase unemployment in such a way that inflation can be kept to a minimum. And that's its goal. Now, that's not supposed to be its goal. But the people that run this Fed and the banking system that's in control of it choose to do that. Now, we've had the full employment bills that have been passed. They've never been applied to the Fed. And yet the government is in favor of full employment. But we never have it. We'll never have it as long as the Fed is independent of politics.
Okay, let's go the opposite. What happens when the Fed decreases the money supply?
Well, you decrease the money supply, you cut off credit, you cut off people's ability to borrow, and people's ability to pay, and people's ability to expand, so you have a depression. And that's what we had in '81, because that's what they did. They cut off the money supply in '81, and we had a depression.
Mullins talks about the depression of the 20s, the early 20s. They were saying there was prosperity, particularly economic prosperity, and small businesses and all, but the Fed suddenly retracted so much money in credit that the small businesses and the farmers could no longer get credit. We had a depression. The farmers were driven off the land. A lot of people were driven out of business. In the meanwhile, the big guys who had the money were able to come and buy up a lot of land and a lot of smaller companies at bargain basement prices. And his point, he says he sees this happening on a periodic basis where they can go in and do that. But this one, he uses it as a prototypical example of how the Fed can cause a depression And particularly then, selectively, particularly hurting certain segments of society and the economy.
Well, I think he points to the Depression of 21 because that was the first time the Fed had a chance to do the right thing, and it did the wrong thing. And it's done the wrong thing almost every time since then. I mean, this Federal Reserve is not in our best interest. This Federal Reserve never works in most of the public's best interest. And Grider makes the argument that they're really there only to protect the bondholders and to minimize inflation, minimize wages. Whether that's true or not, the truth is these people have blown it too many times. And you can just go right down the list of every depression has been caused by the Federal Reserve since 1921.
Since we've had the Federal Reserve.
Absolutely. They have caused it. And they've caused it as an attempt to try to restrain inflation, restrain growth. Sometimes that might have been useful. And of course, in 1979, everybody wanted that to happen. But these people overdid it. And they overdid it because they didn't think, first, they are unaccountable. And they could bankrupt as many people as they wanted to and laugh in everybody's face, and that's what they did. So they've got no harm comes to them to overstate their case. And so they've got no incentive to not overstate everything they do, and that's what they always do. The function of the Fed is to instigate depressions, to reduce inflation, to increase unemployment in order to keep wages down. His position is that there is no interest at the Fed, never, ever, in economic growth or expansion. It's always in terms of, is inflation picking up, and do we need to tighten the money supply? And the reason is, of course, that the bondholders who stand to lose by inflation are in control of the system, and the Wall Street people that deal with the bonds. That's Grider's argument, and it's a pretty persuasive argument that those are the people that are running the economy of the country to the expense of the rest of us.